What's good, everybody? Welcome back to the channel. Hope you're doing well. In this video today, I'm going to be discussing closed-end funds, what they are, what they aren't, and what the difference between a closed-end and an open-end fund is. This is just going to be a simple overview, so let's get into it. All right, open-end versus closed-end. The main difference between an open-end and a closed-end fund is that a closed-end fund has a fixed number of shares, hence the closed-end part of the name, and an open-end fund has a virtually unlimited amount of shares, hence the open-end part of the name. So when you're thinking of open-end funds, think of SCHD, VU, VTI, funds like that. When you're thinking of closed-end funds, some examples are CLM, CRF, ADX. Those are examples of closed-end funds. Just remember, the main difference is with a closed-end fund, for example, if they have 100 shares, they only have 100 shares. If I want to buy 10 more shares after the 100 have already been sold, I can't do that because the fund is closed. They don't create more shares based on demand. That is not the case for an open-end fund. If an open-end fund has 100 shares and I want to buy 10, 15, 20, 30, 100 extra shares, they'll simply create those shares and exchange them with me for my dollars that I have. So just keep that in mind when you're that's the main difference between an open-end and a closed-end fund. Now, closed-end funds do increase their share count, and they do that through what's called a rights offering. A rights offering gives existing shareholders the option to buy more shares of a fund at a discount. The key here is existing shareholders. So to take advantage of a rights offering, you have to be an existing shareholder. Some pros of a rights offering is that it can lower your cost basis because you're getting additional shares at a discount. You can also increase your share count because you're getting more shares than you had previously. And it also raises capital for the fund that is holding the rights offering. Some cons of a rights offering, and I think the biggest con here is share price dilution. So that is a guarantee that you're going to have share price dilution when a rights offering is held. Just so you can kind of get an understanding of that, I'll give an example. Let's say I have a closed-end fund that has $2 billion worth of assets and they have 200 million shares. For me to get the price per share, I need to divide the amount of shares, which is 200 million, into their asset value, which is 2 billion. So 2 billion divided by 200 million gives us a share price of $10 per share. When they hold a rights offering, the only thing that increases is the amount of shares. The asset value does not increase. So the amount of assets that they own doesn't magically go up because of a rights offering. So let's say that they offer an additional 10, 15, 20, 25, 30 million new shares during that rights offering. You run that same exact equation. You're going to divide 2 billion divided by 230 million. I'm not good at math, so I can't do that in my head, but you get where I'm going. That $10 that you had before is not going to be the same price of the shares after the rights offering, because now there's an additional 30 million shares that the asset value is distributed across. So just keep that in mind with the rights offering. A lot of people, they like to go ahead and take profit and sell out of a portion of their holdings before a rights offering and then buy back in, during the rights offering period. So you can kind of figure out how you want to play the rights offering. Different funds have different criteria for how they operate the rights offering. So some funds may say per every 100 shares you own, you get to buy an additional 10 at a discount, or some may say that you can buy the same exact amount of shares that you have. If you own 1,000, then you can buy an additional 1,000 at the discount. Every fund kind of has the different way that they like to run their rights offering. Another con of a rights offering could be the potential for a sell-off. So some people view rights offerings as the fund admitting that they're going through some kind of financial trouble. So why are you trying to raise money? Because you're going through some kind of financial trouble. So some people may see it like that, and that may cause a further decline in your share price through a sell-off. Another con is also concentration of ownership. So you could have fewer people at the top of the fund owning more shares. So if I come into the rights offering owning 1 million shares and I get to buy an additional 10 per every 100, then you can kind of see how that concentration of ownership can kind of start shifting toward a select few amount of people within that fund. right? NAV and market price. So this right here kind of tripped me up a little bit when I was looking into closed-end funds. NAV and market price are not always parallel with each other. So net asset value is the per share value of assets held in the fund minus its liabilities. Market price is the price at which the fund is currently being bought and sold. So when you go on E-Trade or Schwab, whatever that price says in there, that is the market price. So whatever price the brokerage has, that is the market price. Closed-end funds can be sold at a premium or a discount to their NAV. Okay, so an example of that would be ADX. So right now, as you come right here, you'll see a lot of times when you go on the website for these funds, they have all this right here on the front page. But ADX is an example of a fund that's trading at a discount to its NAV. So when you divide up the total amount of shares within the fund and the total amount of assets that the fund has minus its liability, each share is technically, well, should be worth $22.92. That's what that'll come out to. But for whatever reason, on E-Trade, on Fidelity, on Schwab, on whatever brokerage that you use, you're going to be able to purchase those shares at a price of $20.46. So you're getting a roughly 10% discount to the NAV because the share price is 10% lower than the actual asset value of the fund. If I'm not mistaken, I read that ADX distributed, I think 10%, had a 10% dividend, 10% annual yield, dividend yield for the year 2024. So I know in my mind originally I would be thinking that, okay, if I bought it at a 10% discount and got a 10% yield on my dividends, that means I have a 20% total return for the year in the fund. That is one way that you can kind of think of it, but you have to also keep in mind that some of these closed-end funds perpetually trade at a discount. So I know if you're familiar with the PIMCO funds, a lot of those funds forever trade. I'm not going to say forever trade, but a lot of those funds have continually traded at a discount. So how this works is that if you buy the fund at $20, you can't just turn right back around and sell it at $22. So you cannot buy and sell at the NAV on an exchange. So if I buy it for $20 and it never goes to $22, well, then I'm just out that 10%. Now it's good to get funds at a discount because you don't want to overpay, but just keep that in mind that a fund could forever stay at a discount. So you could potentially never be able to capitalize on that 10% discount that you're buying it at. Just kind of keep that in mind. Now, CRF is a cornerstone fund. This is an example of a fund that's trading at a premium. So their asset value, all their assets minus their liabilities divided by their shares, gives a share price of $6.75. That's kind of true value is the word you want to use for of this stock, of this fund. However, on E-Trade, on Fidelity, on all the exchanges, they trade at a price of $8.90. So you're paying a 31% premium to buy shares of CRF. So just kind of keep that in mind that you may be paying more than what the fund is actually worth. Now, a good thing about these funds is that they allow you to drip at the NAV. Dripping at the NAV, if you're not familiar, a drip is just a dividend reinvestment plan. Whenever you buy shares and you receive that dividend, they'll just go ahead and automatically reinvest that dividend for you and buy new shares. What CRF and what closed-end funds allow you to do is that they allow you to they allow you to drip back in at the NAV. So when you're on E-Trade and you buy 100 shares at $8.90, when they pay that dividend, this CRF pays monthly. When they pay the dividend, they're gonna purchase new shares for you at the NAV price, so at $6.75. So even though you pay a 31% premium up front to buy your shares initially, that dividend drip should lower your cost basis and lower your price per share because it's going to purchase the shares for you at $6.75, at a price of $6.75. Now, when they have going back to the rights offering, when they have rights offerings, they don't always allow you to purchase them directly at the NAV. So a rights offering, if you see here that the NAV is $6.75, the price is $8.90. The rights offering may allow you to purchase shares at $8. It may allow you to purchase shares at $7.75, or it may let you purchase them at $6.75. So it's all just dependent on what the fund wants to do. But you'll get your if it certainly should be below, the rights offering should be below this $8.90 price, because if it's not, what would be the point of having the rights offering? So you should be getting those shares somewhere, if not at the NAV, in between the NAV and the stock price. And speaking of closed-end funds, I have sold out of my position in my closed-end fund. So if you look at my last video, which is my very first video, you'll see that I had about $2,500 in CLM. I have sold out of that position and I have reallocated it into Dow. I've also added between, I think I made that video about 3 weeks ago, so I've added $1,700 into the portfolio over the last 3 weeks, which brings my total cost basis, total invested, to $4,224 in my portfolio so far, and that's all inside of Dow. Now I've changed up my strategy, well, really my viewpoint on how I'm viewing this dividend portfolio. As you know, I'm trying to get it up to 100,000 over the next 4 years. My initial plan was to put that $100,000 into CLM and CRF, those two closed-end funds, and then use margin, because if you have a margin account, they'll let you every dollar you put in, I think they'll give you access to like $4. I wasn't going to use the whole amount, just use a decent amount, and then with those margin funds, purchase blue chip companies that are on sale. I'm still a believer in CLM and CRF. I'm still going to be purchasing those funds, just at a later date and just as a smaller portion of my portfolio. What I'm doing now, because as I looked in the market, there are lots of blue chip companies that are on sale that are paying higher than normal starting dividend yields. So one of those companies is Dow. So for this portfolio is going to be built upon blue chip companies that are paying what I believe to be a more sustainable dividend than CLM and CRF. I still think that CLM and CRF are safe funds to invest in. It's just that for my first $100,000, when I look out in the market and I just see all the deals that are available, especially for my asset value appreciation, going this route would just be a lot better for me. You know, my income will be substantially less, but still, I think my dividend and dividend growth will be a lot more sustainable, having at least my first 100,000 invested into these blue chip dividend paying companies. So one of those companies, like I said, is Dow. If you look at a chart of Dow, and Dow is a chemicals company. It's the largest chemicals company in the world, if I'm remembering correctly. You can see here it's way below its 200-day moving average, and it's pretty much at a if it's not the bottom, it is one of the bottoms. If it goes lower, I'll buy more shares, but I'm getting the feeling that we're kind of getting toward the bottom of that price point for this sell-off that's been going on in Dow. The chemicals sector is a very cyclical sector, so it's pretty prone to these big swings. So but I feel confident I'm buying at a good price point. So this is why I've changed up my philosophy, and I'm going to be and right now it's paying like a 7% dividend yield. So this 4,000 that I got put in there is paying a pretty high yield on my funds invested. And now this 294 that is kicking me off in dividends after putting in about $4,200 is still less than the $2,500 that I had in CLM was paying me. Because remember, CLM was paying like a 16% dividend yield. But I think that this I'll benefit greatly from the share price appreciation when Dow begins to appreciate again. So, and it's not just Dow; it's multiple blue chip companies that are paying that are on sale and due to it being on sale, due to that share price going down, the initial starting dividend yields a lot higher. One of those companies is Lionel Basel. Lionel Basel, I believe, is the second largest chemicals company in the world. So Dow is an American chemicals company. Lionel Basel is the European counterpart to that. Dow and Lionel Basel, they make everything from various types of they make the chemicals needed to make various types of plastic bottles, those the gel capsules you take on your medicine that dissolve when you swallow it in your stomach. They make all that kind of stuff. They make Legos, all the resins and stuff for Legos. So the way I view Lionel Basel and Dow is that they're the building blocks of the economy. They make the stuff that makes stuff. That's how I view both of these companies. So I'm going to be loading up pretty much on Dow and Lionel Basel for the foreseeable future. Once I get up to about probably 10,000 between both of these positions, I'll probably look to start looking elsewhere. But there are a lot of blue chips that are on sale right now, kicking off higher than normal yields. So even Realty Income, you see that it's below the 200-day moving average right here. So I believe Realty Income is giving it's kicking off a 6% yield. I can go here and click right here. Yeah, so yeah, it's giving off almost a 6% yield. If I go here to Pfizer, another blue. Pfizer's giving off a 6% yield. It's also below its 200-day moving average. It looks like Pfizer's on the move to start an uptrend. So these are one of the reasons why I've changed up my strategy. I think this is just going to be better for me in the long haul, because if you take a look at CLM, you can see here that their NAV erodes pretty consistently. It's just going straight down over the last 5 years. Now, if you look at the max, I don't know what they were doing back in the 90s, but it used to be $148 stock. It used to be a $255 stock. But you can kind of see here around 2000s era, it started kind of declining pretty rapidly. I assume the dot-com bubble was around that time. I was like 4 years old, so I don't really know. But looks like something happened in the dot-com bubble, took their share price down. Come right around here to about 2008, another huge decline. So it looks like something that happened with the housing market, took their stock way down. And ever since then, it's just been going down and down and down. I don't want people to get the wrong idea about these funds. In my opinion, investing in CLM and CRF, the dividend reinvestment is key. Two things: the dividend reinvestment is key, and also not pulling out the full dividend amount. So if it's paying you a 16% yield, you just need to have a withdrawal plan to only pull off 8% of that, 9% of that, or whatever. I just wouldn't suggest you not letting the dividends drip, and not I would suggest for you to let the dividends drip and to not pull out the full dividend amount. So you want to reinvest at least a portion of that high yield back into the fund to prevent your NAV from eroding. I think this $7 to $10 range is kind of like the right range, and where this stock is going to be staying pretty much for its foreseeable future. I don't ever see it getting up to being a $15, $20 stock. So I'm thinking right around this $7, $10 range is kind of right where the true value of the fund is. But when I get back into these funds, once I cross that $100,000 mark in the blue chips, I'm definitely not pulling out. I'm not pulling off the entire dividend, and I'm going to be reinvesting those dividends back into the fund for the foreseeable future. So that's one of the key things I think that'll make CLM and CRF work for people, is reinvesting those dividends and not taking out that full dividend amount. That's very important. That's a very important two very important things I believe that you need to do to make your income from these funds be sustainable. But that's pretty much all I got for today. I'll be back on with another video when I reach another milestone in the portfolio. If I open up another position, I'll get back on here and make another video. So please like, share, and subscribe if you feel so inclined to do so, and I'll catch you on the next video. Take care.